Hello, and welcome to On the Margin, the podcast where we break down the current state of our economy in more understandable terms. And I'm your host, Madeline Maldonado. And today, we're going to walk through the state of the economy as of mid-2025, covering the topics of labor markets, unemployment, economic growth in the U.S., inflation, and current accounts. And from that, we will look at where we are now, how we got here, and where we might go next. To start us off today, let's start out with unemployment. And before I go into any detail about this, let me explain what the unemployment rate actually is. Many people think that the unemployment rate is extremely high just because of how many people they might know that don't have jobs, but the unemployment rate only calculates for the percent of people actively in the labor force who are looking for jobs but are without jobs. The unemployment rate excludes those who are content with being unemployed and not searching for jobs, those with disabilities who cannot work, those retired, and those too young to work. So before you go thinking the unemployment rate is too low after I tell you it, think about the people who fall under the ineligible for work category and the non-participant category. Now, before I go off on a rant about this, let's talk about the unemployment rate in the U.S. now. According to the Bureau of Labor Statistics, as of August of 2025, the unemployment rate is about 4.3%. So essentially, we want to know how we got to this point. In the aftermath of the pandemic, labor markets tightened dramatically, meaning there are no more job openings available than available workers. After COVID began to fade out and become less fatal between 2022 and 2023, many began to rejoin the labor force, which in turn, wages rose and businesses expanded. Once 2024 came around and a little into 2025, hiring has definitely slowed. More firms are now more cautious, and external factors have been creating resistance like tariffs, obstacles in supply chain, and technological shifts such as AI have introduced a lot of uncertainty. From a historical perspective, anything under 5% when it comes to unemployment rate is seen as healthy. So with it only being at 4.3% in 2025, it's definitely a lot better than it was in 2020, when the average unemployment in the US was 8.1%. Now, let's take a turn to GDP growth. During the second quarter of 2025, which would have been the months of April to June, the U.S. real GDP grew at an annualized rate of 3.8%. After a slightly weak first quarter, the 3.8% makes the second quarter of 2025 the fastest GDP growth quarter in nearly 2 years. Given that strong bounce, we would say that the economy is in an expansion phase, meaning that the gross domestic product is rising and leading to higher employment, greater consumer spending, increased business investments, and generally rising incomes and asset prices. Is 3.8% healthy, you might ask? And generally, yes, because it's above long-term trend growth, which in mature economies like the US, a consistent and moderate real GDP growth rate is typically between 2 to 3% for advanced economies. With the percent being slightly above that, the US is in a comfortable spot, not overheated, but still staying strong. However, a risk can be proposed when it comes to sustaining it because it could possibly trigger external imbalances or a strain in where inflation outpaces the rate of increases in individual or household incomes. With that being said, a forecast suggests we may decelerate in the later months of 2025 due to tariff pressures and more obstacles creating resistance, the government shutdown, and possible global shutdowns. But for now, we seem to be in a healthy expansion phase. As for inflation, as of August 2025, the Consumer Price Index inflation is about 2.9% year over year, which is up from the 2.7% in the preceding months. Along with that, core inflation, which is the measure of price increases that excludes food and energy to reveal the underlying long-term inflationary trend in the economy, is also elevated to 3.1% in some measures. And you might ask, how does that compare to what would be considered just right? The long-run inflation target of the Federal Reserve is seen at 2%. So, with 2.9% being moderately over that benchmark, it's not considered hyperinflation, but it's above target enough to be concerned about. If inflation were much lower, say maybe in between 0 to 1%, there would be concerns about stagnation, or in other words, a prolonged period of little to no economic growth, as well as weak demand. But here, there's risk of overheating or loss of inflation expectations, and the Federal Reserve must balance supporting growth versus keeping inflation at check to provide that just right standpoint. But in all, what should the Federal Reserve do about this inflation? As much of you might not have any clue, in their September meeting of this year, the Federal Reserve cut its funds by 25 basis points to a 4 to 4.25% range, noting that inflation has moved up and remains somewhat elevated, according to an article posted by the Federal Reserve, indicating that they're seeing downside risks to unemployment, sorry about that, but reduce these inflationary pressures. The Fed should remain data dependent and make decisions based on analysis and actual and factual data, because further rate cuts are very risky, and considering modest additional cuts if labor markets soften, but with extreme caution. And last, but definitely not least, we'll discuss our closing topic of current accounts. For those who aren't familiar with the term current accounts, it's the broadest measure of the flow of economic transactions, including goods, services, income, and transfers between the United States and the rest of the world. In quarter 2 of 2025, the U.S. recorded a current account deficit of $251.3 billion, equivalent to about 3.3% of GDP, according to the Bureau of Economic Analysis. This is substantial, narrowing from quarter 1 when the deficit was $439.8 billion, with a 5.9% of gross domestic product. So, in simpler terms, the U.S. is running into a significant current account deficit, but has improved in the past couple months. You may still be confused on if that's a good or a bad thing, and it's not necessarily a good or bad thing, but more so it has its pros and cons. Some pros you might see is that a current account deficit also means that foreign investors are supplying capital to the U.S., meaning they're buying U.S. assets, investing firms, etc. And in turn, that can finance investment. It can also reflect a strong domestic demand environment. Therefore, we import more because we consume and invest a lot. However, some cons may be that large deficits mean more external vulnerability. Since we have to rely on more foreign capital or exchange rate stress, and if driven by excessive consumer consumption rather than our typical productive investment, it may reflect a weaker underlying growth structure. In summary, the U.S. is running a structural deficit. That's not usual for the U.S. historically, but a very large widening deficit is cause for action. All right, that is all I have today for you curious economic fanatics. Thank you for tuning in on today's edition of On the Margin. I hope it was able to enlighten you a little more on the current state of our economy and clear up any questions you might have had. Until next time, keep your finances in check.